When this breaks is when the feds will fire back up the money printer. Now, a lot of people that are watching the markets are waiting for the Fed to pivot, meaning when will they go from tightening, raising rates, and back into an easing scenario where they're lowering rates and printing money or pushing money back into the system? Well, there's a lot of speculation. I have my own opinions, but today I think I've identified what they're looking for to break before they finally pivot. So in this video, I'm going to break down a handful of charts that I'm looking at. I'm going to show you exactly the ratios that I'm looking at, what levels on the charts we're watching, of when I think of what's going to break that's going to cause the feds to pivot back into an easing environment. So buckle up and let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money, because almost everything you have learned is wrong, and everything you see is wrong because they're saying, look over here, and all this other data is right here that you're not seeing. So I'm going to break down a handful of charts that I'm looking at that I think will be very, very helpful for you to navigate what's going on and specifically answer the question, when will the feds pivot? You keep hearing about when something breaks. So I'm going to show you what I think is going to break. Now, by the way, there's probably never been more uncertainty in the markets than there is right now. There's a handful of things that could happen, some black swan events, if you will, and I've outlined a few of them, and we've come up with a plan to see which ones are the most likely, most probable outcomes, and then of course a plan of how to move through those. If you want to come hang out with me live to see what these scenarios are, how I'm planning to move through those, what I'm buying and selling to prepare, there's a link down below. Come hang out live. I do these about once every other month. I'll show you all the charts. We'll go through a live Q&A. It's a good time. There's a link down below. Check it out if you want. All right, into this video. So what is going to break? You hear this. When something breaks, the Fed's going to pivot. So what is it that's going to break? Well, here's what I think is going to happen. The first thing you have to understand is global liquidity. The global liquidity, that's the money, that's the lubrication in the system. Money makes the world go round, so to speak, right? And so when we get into a dollar shortage or a liquidity crisis, things start falling apart really quick. It's another reason why when you see like a quick crash like in 2008 or in March of 2020, not only do you see stocks go down, you see gold go down, you see Bitcoin go down, you see everything get dragged down together because of a liquidity crisis. And so people are selling anything they can to get liquidity to cover their margins and things like that. So we have to be aware of the global liquidity and the tide that appears to be going out. So what am I talking about? We want to look at just like an ocean, the tide comes up and the tide goes down. We want to look at the liquidity in the system to see which direction the liquidity is heading, and the direction of that liquidity is what dictates the direction of the markets. And so the first thing we can see is the amount of money. This is the global M2 money supply, not just for the United States, but globally. And we can see since about 2003, it has been going up at a pretty crazy rate. What we can see though is in the last year, it's been pretty flat. It kind of leveled off, it made a new peak, but now it's starting to come back down. So we want to see the amount of money, but we also want to see the direction that the liquidity is going in. So we can see that the liquidity is going down right now. What we can see is that while that's receding, we can see that the direction is also changing. So while the total supply is going down, this shows the change, the year-over-year change. And so what we can see going back here to 2019 right here, the change was the amount of money was going up. This is how fast they're adding to that liquidity, how fast that tide is coming in. And we can see the tide came in extremely fast, and now the tide is going back out. Remember, the tide sets the direction. So we can see the liquidity, like the tide came in, and now it's going back out. While the volume is still up very high, because it doesn't actually go down, it's the rate of change or the direction that we're trying to pay attention to. Okay, now what we can also see when we look at the rate of change is that we can see the liquidity crisis really changed in 2005 right here, before the big 2008 crash happened. So we can see that it started changing down, which led to this big crash. We can also see that it started happening here before we had this first crash. So it starts to tell us the direction that things are going. It's important to watch it from that perspective. Now, you might have heard this quote from everybody's favorite investor, Warren Buffett. He says that only when the tide goes out do you discover who's been swimming naked. The first part of that quote is that a rising tide rises all boats. And so what does that mean? Well, in an event like after coming out of March 2020, you could pretty much close your eyes and throw a dart at a stock board and pick a winner, right? So everybody looks like a winner, everybody looks like a genius. A rising tide lifts all boats. But only when the tide goes out do you discover who really knows what they're doing, who is swimming naked. And so now, as the tide is going out, what do we think is going to happen? So can we, or could we have seen this coming? Can we see this as a leading indicator? Well, what we can see is that growth expectations have been plummeting, and they are a future cast of what the future expectations are. So what I have right here is a growth expectations. This is the tech bubble right here. We have the great financial crash right here, and we have the CV, the cerveza sickness crash right here, and are we seeing another one? This is the 10-year yield chart, and we can see that they've been able to forecast each recession. So when they topped out here, the markets crashed. That was tech bubble. When they topped out here in 2007, we can see that we had the crash into 2008. They topped out here in 2019, and it led to the crash that we had here in 2020. And are we seeing another one? Is the 10-year showing us what to expect in the future? Of course, these are viewing things out into the future. Now, what we can also see in this bellwether chart is that when we have growth being below the price of money. So this is a bellwether chart. This is the 2-year and the 10-year yield. And what we can see right here is, again, growth expectations have fallen below the Fed funds rate. So they're expecting more loss in the future, is what this is showing us. Now, this is the 2 and the 10-year, which is one chart that I like to look at. I also like to look at it over a different time frame. Here we have a 3-month and a 10-year, and it's showing us the same thing. We haven't quite inverted yet. We need to cross this red line, but when this crosses through right here, this shows us that growth expectations are low, meaning that we're having a massive recession is on the way. Now, we can see that, as I've been saying over and over, that the future is more uncertain now than ever before for many reasons. I'm not going to go through all of them. And because of that, there's lots of fear creeping in. You hear about FUD, fear, uncertainty, and doubts. We have uncertainty and we have fear that creeps in. The volatility shows us the amount of uncertainty in the market. And so as it becomes more uncertain, the volatility spikes. And we can see that priced by options. So we can see the amount of people that are buying insurance against their positions. Now, if we look at the volatility in a chart, what we can see is that we have this uptrend that's forming right here before a big crash. That was in 2008. And what we're seeing is another pattern right here. And could this be telling us that there's another big crash coming right here? Now, again, these are just one indicator. They're not conclusive on their own, but they're things that we want to look at together conclusively. What we can see is that we're primed for another massive volatility explosion. Okay, over the next 12 to 24 months, what does it look like is possible? All right, so I've already outlined what I think the Fed is watching. You know, yes, they care about full employment. Yes, they care about the stable prices. I don't really think they care so much about the economy. I don't think they care so much about your job or retirement. They really care about those two things. But what they really care about more than anything is the liquidity in the system. The job of the Federal Reserve, the central bank, is to backstop the other banks. They need to make sure that liquidity is going through. So keep an eye out for that. Right now, we're in this kind of wait and hold position. And so we like to be in risk off assets, physical gold and U.S. Treasuries. Those are things that I can hold physical gold in my house, in my safe, in my possession. U.S. Treasuries are a risk-free asset. There's almost zero chance that the government would default on that. Now, if you're watching these charts like I've shown you and liquidity starts to dry up, then the Fed will be forced to pivot. When the pivot comes, then we'll want to move heavily back into risk-on assets. So we'll want to scale back into certain equities that are cheap, Look for the PE ratios. I've talked about this extensively in other videos. Leave me a comment if you want me to break that down even more. Equities and Bitcoin is another one. Risk on assets when that Fed pivots. Until then, we know there's demand for risk off assets. Some of those, like I've talked about, of course, I've been talking about commodities, which have done really, really well, etc. But that's what I expect to happen. That's what I expect the breaking to be when the Fed finally is forced to pivot. Again, they don't care about your retirement account. They don't care about your job, your economy. What they care about is the liquidity in the banks, and the tide is starting to go out. But let me know what you think down below in the comments. Of course, check out the link I have down below if you want to come hang out with me next week. We're going to go deep into this. I have about an hour worth of slides to go through. We'll go into live Q&A, show you what I think is the most probable outcome and what I'm doing about it. Check out that link down below. Give me a thumbs up on this video if you like it. If you don't like the video, that's okay. You can give me a thumbs down, but at least tell me why. Leave me a comment. Oh, and hit that subscribe button while you're at it. And that's what I got for you today, right? To your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably gonna really like this video right here and this video right here.